Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today on the podcast, we have my longtime friend, Anton Mattli. Anton is the CEO and co-founder of Peak Financing and has decades of experience in commercial and investment banking, private equity, and commercial real estate. After graduating from Zurich Business School in banking and finance, he held senior management positions at major financial institutions in New York, Tokyo, Hong Kong, and Zurich. Over the past 15 years, Anton has been advising family offices, high net worth individuals, as well as private investment funds, facilitating their direct investments in commercial real estate across Europe and the United States, amounting to several $1 billion in multifamily and other commercial real estate developments and acquisitions. Thank you for joining us. Can you start by telling the listeners a little bit more about yourself and what you do, Anton?
Yes. Hi, Gary. Thanks for the intro. Sure. As you mentioned, I went to school in Switzerland. I was born in Switzerland. And shortly after graduating, I then came to the US, worked for an investment bank there on Wall Street, then went on to Tokyo for 4 years, Hong Kong for 3 years, and then I left banking and we started our own business, advising a couple of family offices with their commercial real estate investments. And as a result of that, I happened to end up in the US because we had a number of projects in the US that were long-term projects. And with that, we also saw the need when we arranged the financing that there is actually a need for independent debt advisors and debt brokers to help investors with their financing. So our arm, Peak Financing, really grew out of that personal need, and that's where we are today.
Nice. Obviously, it's been a wild ride the last 12 months as far as rates. What are your thoughts on where we currently stand in commercial real estate regarding the lending environment?
Yeah, it's only a crazy ride. We have seen after an unbelievable run-up of roughly 10 years, right after the great financial crisis and the recovery in commercial real estate and multifamily that started in 2010, 11. And we essentially had to run all the way to the early 22 when prices more or less only moved up. And as you said, we have had a wild ride since then with the Fed rate moving up very significantly, faster than ever before, to a level that obviously has had a very significant impact on valuations, as well as on the lending environment. And when we look at 21 and early 22, when interest rates, both for floating rate loans as well as for fixed rate loans, were in the threes, sometimes even in the upper twos, and now even for the best borrowers, we are still in the low fives. Obviously, we talk about essentially doubling of rates over that period. And that together with lower valuations, it's no surprise that everyone now is struggling with a much higher borrowing costs. Obviously, in our world, the syndication world, everyone talks about that, and sometimes there is also that notion that it's only syndicators that are impacted by that, but that's only far from the truth. Institutionals are impacted too. Large players are impacted. Obviously, they have more ability to overcome the storm, right? Because they have, generally speaking, bigger pockets to overcome these issues, but they're facing them too, right? So, but obviously, when it comes to particularly 21 and 22 loan originations and deals that were done, as you know, a big chunk of those, particularly in the syndication space, were done with bridge loans, even for properties that could have qualified for agency financing or fixed rate financing, permanent financing, but because the leverage would have been so low, somewhere in the 50-55%, everyone was drawn to the higher leverage that bridge loans allowed them to get to. And in hindsight, obviously, it's easy to say you shouldn't have done that, right?
Yep.
But when you have a massive difference then in leverage, it's obviously the attraction was definitely there, right? So where are we today out of this? Interest rates are still elevated, particularly if you want to refinance. Whether it's a floating, it has improved a little bit, right, with the Fed rate coming down by roughly 1 point. But the fixed rate side, the all-important 10-year Treasury really hasn't come down. For a brief period, last September, we were down at close to 3.5% for a very brief period. And whoever could refinance back then did it. And now we are back to above 4.4 as a 10-year Treasury. So we are essentially in a very difficult spot still, resulting in refinancings even for, in best cases, in the low fives. And depending on the location, property, and sponsor, we talk about upper fives to the mid sixes. And that still is a big challenge when you need to get out of these bridge loans.
Yeah. You're talking, leverage is as high up as 90%. And if your property, if you bought in end of 2021, 2022, your property is probably worth 20% below that. And so now you have this problem where you have to bring in a lot of cash, and some people have been able to do that and have a capital call, or in the rare case, the GP was able to come up with some money, or they've created these pref funds. But in cases even with like Starwoods or some of the big companies like you mentioned have walked away from properties as well. It's not like you said, it's not just the small syndicator. It's up and down the field that people have paid a price.
Yes, definitely. Yeah, and obviously, if you have a REIT like you mentioned, Starwood, it's much easier to absorb some of these losses within your REIT because you have a fund, right? So it's not the end of the REIT. Obviously, your net asset value definitely has come down. And one can then start the discussion of what is the true net asset value for some of these REITs. So this is really what I was referring to, right? So they certainly can deal with these situations in a much better fashion because of their borrowing power, because of the overall liquidity that they have, and because they have a whole portfolio that sits in a fund. But that doesn't mean that certainly on paper currently these properties have a much lower value, right? And I would say it's a clear signal when some of these large players also stopped allowing investors to withdraw the money for a certain period of time. So it's not just a liquidity issue, but it's also a valuation issue there, right? So that's really what I think is again an important point to make, that it's everyone is impacted by this, and we just need to find a way out of it. Hopefully, these losses are limited. But at the same time, we have to be realistic, right? Values are down 20, you mentioned 20, and some markets they are 30% plus. And numbers are numbers, right? You just cannot do much about the fact when you have to refinance or sell that the values are down. I think it's important just to recognize sometimes you take a loss, as it is in the stock market and bond market. And I would really recommend also for investors just to consider that average cost investing should also be applied to private investments, including multifamily, right? So don't just look at the single deal, but look at for the long horizon. And I fully get it. Anyone who just started investing in 21 obviously is not in a good spot, but many investors have been doing it for the last 10 years. And when you look at the overall returns that they were able to achieve, it still looks very good despite what we are facing now. And then on top of it, I think with all these changes and lower valuations, we see a lot of opportunities, right? So this is whenever you have situations like this, someone suffers and someone benefits, right? And it's if you are a long-term investor, hopefully they are willing to accept the fact that it may be hurting now, but if you have a long-term view, it still will be fine, and there will be a lot of opportunities, particularly if you're buying today at the right price. I'm not saying that all the properties that are currently offered for sale are still priced correctly, but if you pick the right one, then I think it's a good strategy.
Yeah, we're definitely seeing where we purchase. Sellers are much more realistic about their pricing, and if you can get a deal, there's some great opportunity to be had. On the lending side of things, we're seeing even some deals that were like perfectly performing on. We're having lenders aren't nearly as amiable because they're getting hurt on other loans. It's an interesting dynamic where we're like, well, why is our relationship harder than it needs to be? We're perfectly performing, and we're suffering because of some of these other loans, and some other lenders too are getting, as far as their are digging into our financials and really wanting to understand every little piece of how we're going to perform. If our DSCR is below a 1.25, or they're just getting much more involved. Obviously, they want to protect their money as well. Are you seeing the same things?
Yes, so lenders definitely are scrutinizing real estate own schedules now than ever before, right? It clearly is a sign of the times. As you mentioned, they're virtually all lenders, their portfolio has deteriorated. If you're a permanent lender and an agency lender, that portfolio has deteriorated relatively little, but it still has deteriorated, right? So obviously the warning signs are there. The watch list, the number of so-called watch listed loans only have increased, and once you have that, everyone is trying to tighten their portfolio. And so only when it comes to new loans, then they really are scrutinizing the deal sponsors and what they are currently exposed to. And unfortunately, that's right now. That's just the way everyone is doing it. And bridge lenders, obviously, they are even in a tougher position because whatever any bridge lender tells you, oh, we are fine, they are not fine, right? So that's just not the reality out there. And again, just coming back to what you mentioned before, 20% valuation drop, a lot of markets, it's more than that. That's essentially where we were at the loan to cost level. So they know that the equity in many of these deals essentially has been wiped out, and all what they want to do is protect their own position as a lender. And as a result, when it comes to new loans, they still need to originate new loans to keep the lights on, right? They cannot just live from the servicing of the existing loans. So they want to do it, but they want to be more careful about it. And for the right sponsors, for the right property, for the right business plan, this is the good news. Financing is readily available. Right, so it is not that the financing is tight. It's really more that the underwriting has become tighter, so that they are much more picky which properties and particularly which sponsors they are comfortable with. Right, so I know it's painful to explain every single property on the real estate owned schedule. But we as step brokers, we help to create that story. We go through the REO schedule with borrowers before we even go to any lender, so that we fully understand what the situation is. And then based on that, we can be very transparent with lenders what the situation is and what the plans are for these properties, right? So it's not really, also when it comes to the REO schedules, please do not just stick to valuations as they were in 21, right? That you plug in there. Be fair with what you present. And because if you are essentially just using whatever the best case was in 21, lenders see that immediately, and it creates that bad vibe with a lender, which you want to avoid at any cost, right? So it's much better to be honest about it than trying to hide it, because lenders, their underwriting, it has now been going through so many of these deals. They will find any issues with every single property anyhow. So it's better to be upfront right from the start. The same applies if anyone had obviously a foreclosure, please disclose it up front. If you had a short sale, please disclose it up front. It can be explained. That doesn't necessarily mean that you are not able to borrow from that lender, but I can guarantee you, if you do not disclose it, if you say everything is fine, and then one finds out as a lender doing the underwriting that you did not disclose it, you're dead in the water, right, as a sponsor. So don't do it. Yes, it's painful to disclose all these painful experiences, but you're still much better off to do it up front.
Obviously, there's been a lot of loan modifications, and there's still going to be some loan modifications. What is your best advice for someone that has to go through one? And they're scared, and they're not, they're struggling to pay their mortgage on their real estate every month. What would you suggest?
Yeah, so I would say the most important part is obviously, as long as you can, make your payments, right? There are some strategies that have been floating around. Stop making your debt service payments, and that brings the lender to the table for negotiation. This is the worst thing that you can do, right? So once you stop making payments, do not expect the lender to be willing to negotiate anything, right? So it creates a very tough environment for you to even have that discussion with the lender. So that's really my first advice. Obviously, if you run out of money and don't have a choice, that's a different story. But do not apply this as a strategy if you can make the payment. Now, when it's loan modifications, we are really, for some loans, we are already in the second round of a loan modification, right, where they already went through 2 modifications. Some of them may have gone just through 1, but now there is another modification that is we are hitting. And it definitely has become much harder, right? The first round of modifications were much easier to do because it was just a start. Now lenders are tightening it. They've really started realizing that there is not much of a likelihood in a lot of instances where the sponsors are able to turn the property around. And if they foreclose the property, that the lender would actually be in a better position a year or 2 years from now, right? In the past, they still believe, though the sponsor may be able to do it, but now they recognize, I think, if we let the sponsor run this for another year and modify, the property will be likely in a much worse position than we foreclose today and start the asset management and inject some more money today. Having said that, if you're a borrower in that situation, the best case, obviously, we help with these situations where we advise sponsors how to prepare and what to focus on with loan modification requests. But once that is done, and we have seen it now in multiple cases, try to get a one-on-one meeting with a lender. And that is not always possible, but at least attempt it. We have seen some very good results when one-on-one meetings were possible, where it's always a difference whether you actually go through Zoom calls or email exchanges and have in-person meetings, right? So we, as it is, right, with relationship building, you can have a lot of communication by text, by email, and over Zoom calls once you know a person. But to actually build that additional trust, very often that in-person connection can be very helpful. And not all lenders are willing to do it, but I recommend that at least if you're in that situation, attempt to get that in-person meeting, even if it means that you have to fly out to New York or Chicago or wherever that lender is. It's worthwhile your time. That doesn't guarantee that they will be willing to accommodate you, but if you're already in that situation, I think it's only worthwhile your time and cost of travel to do that.
And, best case scenario, are you just looking to get an interest rate cut and they make it up at the sale, or how do these typically work?
Yeah. I would say there are some lenders are willing to cut the interest rate. I would say that has been now a pretty common occurrence. Some lenders are also willing to do a rate cap that is not the original strike price, let's say at 2 or 2.5%, but to bring it up to whatever the strike price today would be, that supports a reasonable rate cap cost, right? So let's say at 4% or 4.5% or even 5% as a strike rate. So that is very common today for lenders to accept it. What we also have been able to negotiate was rather than buying a rate cap, just escrow the funds for the shortage in the debt service. So that, let's say, if you can sell or refinance within 6 months, that you do not have the full amount of the rate cap lost, right? technically, you can sell that rate cap when it's still 6 months left, but it's not much value there. So you're actually much better off if you can not to have to buy the rate cap, but just escrow the same amount, right? So from an outlay perspective, it's still the same, but at least you have a chance to potentially get some of that money back in case of a sale or a refinance. Now, when it comes to extending or modifying, obviously, the easiest is to do it for 6 to 12 months. The problem is with that, that comes around very quickly. So I would recommend to come up with a business plan that is actually reasonable. And if that business plan outlines, look, I cannot really refinance realistically or sell in 12 months from now, but in 24 months from now, ask for the 2-year extension rather than just a 12-month extension. Or in some instances, we have even seen that they're willing to do 3 years with a strong sponsor and a strong business plan, right? Just asking to get out of the current situation for 6 months or so, obviously is easy to do, but you will be in the same spot so quickly. So that brings me to the last point, what we have seen a lot of sponsors just do not spend enough time to truly do a proper business plan that they present to lenders, right? So you need to spend a considerable amount of time to come up with a realistic business plan that you are absolutely comfortable with, that it can be achieved in, obviously, there are always, you may be a little bit aggressive, that's okay, but at least that it's reasonably achievable. And once you have that, go to the lender with that. But we have seen a lot of deal sponsors that are coming up with business plans that are just not worthwhile to even have a discussion with. Right? So this is, I would say, one of the biggest problems we see. And I understand when you are a deal sponsor, particularly when you have multiple deals, you're under stress and you don't have enough money. So the last thing you want is to do all the research. But this is just a key piece to win that extension discussion with a lender.
Really good advice. Thank you. I'm sure you get asked this question all the time, and I know you don't have a crystal ball, but where do you see rates going in the next 12 months?
Yeah. So when it comes to the Fed rate, frankly speaking, I have no idea what President Trump is going to do with Jerome Powell or not. Now, obviously, if he is trying to get him out early, I think there is a slightly better chance that the Fed rate may drop a little bit quicker. But we should not forget that Jerome Powell is 1, right, out of 12. So we still, we just have to be a little bit realistic there. But it definitely will be the case if he will be replaced early. I would say there is certainly a higher chance that they would drop the Fed rate a little bit more aggressive. Always assuming that we do not have suddenly a run-up in inflation, right? So a lot of people say, well, tariffs do not have any inflationary impact. Well, the problem is that, first of all, it takes time for tariffs to really bite because importers and manufacturers, they can draw from inventory first. And a lot of these tariffs have been delayed anyhow. Some of them have not even started until now. So we have not really seen the impact. I feel that we still have that inflationary pressure there. And I certainly would feel that the market has the same view, right? So when we look at the forward curve, it's still a slight upward curve for the 10-year Treasury, 5, 7, and 10-year Treasury, and even the longer end of the curve. So even if the Fed is dropping the rate and has the ability to drop the rate because inflation really is getting close to that 2% mark, I do not really believe that the longer end of the curve is really coming down significantly. So my view is that even over the next 12 months, we will likely be in the fours for the 10-year treasury, and we might be briefly dropping below the fours until we are back up again, right? So we also need to recognize that once we drop the Fed rate and the international markets see that the US dollar also will lose in value. Further, we already have lost significant value in the US dollar, and we are dependent on foreign investors too, and they demand a certain premium for investing in US treasuries. So I think really that's where the market is just pushing to be in that handle with a 4 for the 10-year treasury yield. So I do not really see that we have much relief there. As real estate investor myself, and obviously being on the debt side, we would love to see a significant drop in rates, right? But I just do not feel that is realistic. And I would just say whenever there is a brief drop, hopefully below the 3% mark, if someone is refinancing and can do the rate lock, do it then, right? If you have an acquisition and there is a brief drop, try to do the rate lock right at that point. But from a outlook perspective, I would say do not expect that you will get much relief on the 5 to 10 year treasury curve, which is, as you know, the all important curve for refinancings. And even though it's not directly correlated, even for property values, right, with the cap rates. So not much relief in my view there. But from a buyer perspective, if you're a buyer, obviously if you're a seller and trying to refinance, that's terrible news. But if you're a buyer, if you can find properties that actually underwrite at these interest rates, that's actually, in my view, a very comfortable position to be in, because now we are at rates that are reasonable. And if somehow interest rates drop within 1, 2, 3 years from now, well, cap rates will likely go down too, and values go up. So, right. And so even if values do not go up, at least you could refinance at the much more favorable rate in 2 or 3 years from now. So if you're on the buying side, again, as long as the deal underwrites to today's interest rates, I would say don't worry whether we are below the 4% mark treasury-wise or not. Just underwrite to whatever it is today, right?
One last question for you, Anton. You know, if someone was awarded a deal and they're looking for a loan, what advice would you give them?
So first of all, what I would suggest is, and really strongly recommend, get independent quotes, work with a debt broker. And obviously we are a debt broker, so we might sound biased, but I really mean it. Even if you are not working with us, you need to have independent advice when it comes to loan quotes. You cannot rely on whatever the listing broker is showing you of quotes that they have collected from very often the in-house lender or in-house broker. Their purpose is to show you the best possible situation. And very often we look at these loan quotes and underwritings all the time. They technically can be achieved in the best of all circumstances, but you have to be much more realistic when you underwrite a loan. And so that's where an expert debt broker really can help. And I would say do that actually before you submit your LOI, because if you do it afterwards and you have your LOI accepted, because you already underwrote to a certain number and now the loan amount comes in much lower than what you assumed, then you're already in a difficult situation. You potentially have to retrade with the seller and the listing broker, which actually puts you into a very bad position, and your reputation is also negatively affected. So just do it up front so that you are comfortable with what you are underwriting to. And then once you are under contract, obviously the real work starts. Should you go with a fixed rate loan or with a floating rate loan? Obviously, that's a question a lot of people ask. When it comes to truly distressed assets, you have to go with a bridge loan anyhow, and whether that is a fixed rate or it's a floating rate, in my view, doesn't really matter. Even if it's a floating rate, you buy an interest rate cap and you quasi turn it into a fixed rate anyhow for that whole long period, right? So that is, in my view, is not really a problem. Just make sure that, let's say you have a 2-year or a 3-year bridge loan, that you may want to consider to buy the interest rate cap for 4 years or 5 years, even though you have the intention to refinance or sell in 3 years. Yes, it's additional cost, but at least you can truly feel comfortable that you are protected interest rate-wise for the whole period. Now, when it comes to a stabilized asset, right, that could go with an agency loan, well, maybe if you truly believe that the Fed rate will drop and short-term interest rates will drop over the next few years, maybe you want to go with a floating rate. But there again, make sure that you actually buy interest rate caps for not just for what a lender asks you to do initially, but for a much longer period, so that you are protected if that play is not going to work out for you, right? So there are borrowers that are, particularly on the institutional side, that go specifically strategically with floating rate loans. And particularly when you have a whole portfolio, it's also much easier to do and hedge. If you do individual transactions with individual loans attached to them, I'm not saying that you shouldn't do it, but make sure that you truly hedge that floating rate exposure, no matter what, right? So, if you go with fixed rate, as always, right, just remind yourself when you sell or refinance, you will have that prepayment penalty with a lot of these loans. So there is nothing wrong with it. Just build it in your assumptions, because in your exit assumptions, because we see it over and over and over again. Everyone is talking about, okay, we sell for this price and that price, and here are the closing costs, but the prepayment penalty is nowhere to be seen. Right? So that's my recommendation there.
Nice. Well, I appreciate you coming on. Certainly, every time I talk to you, I definitely learn a lot, and I'm sure all of our listeners will too. Anton, where can listeners find out more about Peak Financing?
Well, go to our website, peakfinancing.com. My email address is anton@peakfinancing.com, anton@peakfinancing.com. I'm also active on social media, so you find me on LinkedIn, on Facebook, Twitter. So pretty easy to reach. And I'm always happy to help, always happy to have a discussion about anyone's situation, and we live and breathe that world day in, day out. So it's a fun part to be in.
Well, I appreciate your expertise in sharing it. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.